Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Will we see an interest rate cut this year? There's a growing number of economists suggesting that it won't happen at all in 2024 and instead it will be 2025. One of those is Warren Hogan, Managing Director of EQ Economics and Economic Advisor at Judo Bank. He, of course, was previously Chief Economist at ANZ. He was also the only economist to correctly predict almost a year out that the official cash rate would hit 4.35%. Warren, welcome back to Fear and Greed.
Thanks for having me on the show again, Sean.
You've had a pretty good track record over the past 12 months or so, particularly around interest rates, Warren. We had the Reserve Bank Board release its minutes from the last meeting yesterday. What did they tell us?
They told us pretty much what we knew, and that is that they know about as much of the future as anyone else, and that's not much. It looks like it's playing out as planned. The economy is gradually sort of removing that excess demand. The supply and demand balance is sort of coming back. Inflation is gradually coming down. And yes, at some stage, they might be able to cut rates, but they're not ruling anything in or anything out. And that terminology is very clear. And to me, that tells me that they really don't know what's next. And I think the next 3 or 4 months are critical for the Australian economy, for the trends around inflation and then ultimately interest rates. And I think it's all up for grabs.
Okay, so what are the things that the Reserve Bank is looking at? And I mean, obviously it's inflation, but it's more than inflation, isn't it?
It is. It's essentially this sort of excess demand in the economy, and that's measured in a range of different ways. The obvious one and the most important element is the excess demand for labour, and they're talking about it coming gradually back down into balance, but the economy is still running above its potential. And that's why we're still seeing inflation above target. That's the way they sort of frame it. And they're hopeful that it's going to continue to, that gap close, that excess demand is going to come out of the economy. But they're sort of relying on the past tightening of policy to do the work. We've seen only one rate hike since 1 July last year. And of course, that nominal tightening, that massive 425 basis points of rate hikes is sort of working its way through the system. And the big question is, what's left when that's worked its way all through the system, probably by the end of this year? And the answer is a real interest rate, that is the interest rate minus inflation, that's still very low by historical standards. So I think they're being very cautious for a good reason. They don't have any reason not to believe their current outlook is the right one, but they know it can go any way from here.
So from where you sit, when do you think the next, well, firstly, is the next move a reduction, which I'm presuming, but maybe you have some other view on that, and when will it happen?
So at the moment I have as the central case that they will get the job done with a 4.35% cash rate and that they can start to look to take some of that tightening out of the system next year. And I've moved from November to February 25, so November 24 to February 25. And the last couple of weeks, we've seen some stronger data for 2024, particularly in terms of the business sector. So it just is taking a long time for this economy to rebalance. And of course, it not just has to rebalance, it has to be showing signs of producing some slack for them to be comfortable with cutting rates. So I'm very much of the view that it is going to take a while before they'll be comfortable easing. But I also, at the same time, am putting a lot of emphasis on the fact that we can't rule out rate hikes sometime in probably late winter or early spring if the economy actually starts to come back. And the reason I sort of highlight that risk is we're seeing it happen in many economies overseas. And as I said, the tightening impulse that's been put into this economy by the 425 basis points of rate hikes over the last couple of years, it will soon wear off and will be readjusted to this new level of rates. And the question is it the right level? And all of my models tell me we're still a little bit short of the right level, but my models could be wrong. So, and we also know that they're only going to tighten further if they absolutely have to. So I think the right call is still a cut as the next move, but it's certainly not going to happen quickly.
Stay with me, Warren. We'll be back in a minute. I'm speaking to Warren Hogan, Managing Director at EQ Economics and Economic Advisor at Judo Bank. On the ground, be that through EQ Economics or your role at Judo Bank, I'm sure you talk to businesses, small and medium-sized businesses. Have you been surprised by how resilient they've been?
I certainly have. I've been surprised how resilient they've been through the whole COVID, the whole last 4 years, through COVID, through the recovery. It's been an incredible period of challenges. And what we're seeing early in 24 after the summer holidays is an improvement in sentiment. So we know that the slowdown was driven by consumer belt tightening and slower consumption spending, but business was really starting to get worried and feel it towards the end of last year. But there's been a noticeable turnaround in sentiment this year. We're certainly seeing a lot more inquiry for expanding businesses and investment. And I think that reflects maybe the last rate hike is behind us. We're seeing equity markets on record highs, dwelling housing markets are rising. So I actually see in the last few months improved sentiment, and the business surveys are showing that up as well. But we've only really got one data point on the consumer, and that was last week's retail sales, and they were okay, but they certainly weren't spectacular. So there still is question marks over this economy, but I think we're starting to see a bit of an improvement in 2024.
Kind of bringing all this together then, what you have said in the last few minutes is that we may not actually get a lot of interest rate relief in the short to medium term then.
Well, I think that's another important point that isn't being talked about a lot is, so if the RBA does start cutting rates, how much are they going to cut? And my very strong view is that it's not going to be by much. They might take the cash rate down to 3.5. And then the next move after that is probably to be up again, 2 or 3 years down the track. I mean, I think we still live in a world of cycles, but we're living in a world of chronic labour shortages. There's going to be constant upward pressure on real wages now for many years to come. And that's just going to keep the cost structure for business constantly under pressure and, of course, therefore, inflation under pressure. So the new normal for interest rates is a lot different to what we've known in the last probably 15 years. So I think a neutral RBA cash rate is somewhere between 3.5 and 4. And therefore, when they do cut, is assuming it's in the absence of a sort of a recession or something more severe to the economy, but when they do cut, they'll only do a little bit. And then, of course, the question will turn to whether or not they're going to tighten again at some stage in a year or two's time. So I think that's the right way to think about it.
Okay, so if I'm a business and I've been running for 15 years, I'm about to hit a period which I've probably never experienced before, simply because rates have been so low post-GFC. But this is probably the old normal. I don't know, the new norm, whatever it is, Warren.
Well, it's back to the normal from, I see it as the golden era of the Australian economy in the 90s and noughties, when we really lifted the living standards of everyone and performed very well, high productivity. And I think we're going back to that world. I think I'm very positive on productivity and I'm positive on business investment, but it does mean the cost of capital is going to be elevated and the cost of funding is going to be elevated compared to what we've known in the last 10 years. But when I speak to people in business, that's not what they're worried about. Households worry about interest rates, or heavily leveraged households worry about heavy interest rates. Businesses aren't too concerned because it's a cost that they can write off their tax. They're concerned about, is their business running well? How's their market going? Can they find the right labour? This sort of thing. So I think businesses are very ready to adapt to this new world of interest rates that have been higher than what we've seen.
And you just mentioned productivity. It seems to be something we've spoken about forever, improving productivity, particularly in the last couple of months. You're reasonably confident that will happen?
I am. Over the medium to longer term, i.e. 2, 3, 4 years plus, we have chronic labour shortages, the result of the retirement of the baby boomers, and that's not going away quickly, even with our high immigration rates. And that's essentially going to be sending a signal to business to invest in labour-saving technology, which is the definition of productivity. So I see business in good shape to make these investments, whether it's as simple as better plant and equipment, better software, all the way through to the AI story. I am positive productivity over the decade ahead. In the short term, though, because labour is relatively cheap, that is, real wages haven't been, well, they've been going backwards, it only just started to even out. Businesses are able to apply more and more labour to the capital stock at the moment and make money out of it. And that's what's killing us in the short term around productivity. So until we start to see the economy really slow and squeeze business and they have to therefore make some tough decisions, is cost cutting the new black, I don't see the productivity story turning around quickly. And that employment number we got for February just shows you that that process still seems to be in play. That is continued application of labour to the capital stock, and the high immigration just seems to be feeding that beast of labour demand So it doesn't seem to have changed a lot, but we'll wait and see. I think the next 3 or 4 months are absolutely critical. And I do worry, and I worry about a strong economy, because I do think that then therefore means we're going to need higher rates, and that's going to put massive pressure on the RBA. The politics of it's horrendous, as we can see. And if they're having to tighten again, it's going to be a very, very tough period for them.
Warren, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Warren Hogan, Managing Director of EQ Economics and Economic Advisor at Judo Bank. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.